everybody, and welcome back to the next episode of the investment philosophy and prospectus series we got going on here. So, in the past two videos, we covered these four sections. So, if you're just now clicking on, go ahead and watch these videos first before you continue here. But in this video, we're going to go over risk factors and risk management and controls. So, I say these are also two like very important parts when it comes to investing is understanding risk and understanding kind of like your tolerance of risk. Um, because it's important to understand risk because there's going to be times when you may think that you're investing in something that is what you consider a good buy, but there may be underlying risk for that company. Um, and that could be market risk, that could be sector risk, that could be just risk in general for the company. So, like for example, earlier this year, Google was going through antitrust lawsuit or whatever. The UK was claiming that they're a monopoly and that they needed to break up Alphabet. So they needed to break up like YouTube to a separate entity and other things of that nature. They were trying to break up Google basically. So Google's stock price, kind of took a hit. I think it was down like 6% whenever that was first announced. And then it kind of consolidated there. Fast forward to now, I think at the time Google stock price was at like 170, $180 a share, somewhere around there. Fast forward to now, they beat the case, and now the stock price is at like $300 a share. So that's just like understanding the risk that you were taking if you were to invest in Google at that time. You were basically betting that, well, I wouldn't say betting, betting's not a good word, but like if you really believed that Google wasn't going to get deconstructed and you had a feeling that it would all work out in the end and you bought there, you were taking on that risk that they did get deconstructed, which then maybe the stock price would have taken a hit then, but you're also taking that risk that they don't get deconstructed and now you appreciate the gains from that. So that's kind of like where the higher risk, higher reward comes into play. Like the more risk you take on, the more reward that there is in the market. And it's just kind of like an unwritten rule. It's not really an unwritten rule. It's kind of written, but like the less risk you take on, the less you're going to appreciate in gains. The more risk you take on, the more you're going to appreciate in gains. So, but yeah, so going into this, so for risk factors, so identifying market volatility and drawdown risk. So market risk is just in general, you're investing your money into the market, you're taking on market risk. So basically you're taking on the risk that whatever company you're invested in, you're taking on the risk that of the company that the country that it is located in, you're taking on the risk of their economic like stability. So like if you were to invest in 10 Cent Holdings, they're Hong Kong, so you're relying on the Chinese economy to basically do well instead of like focusing on the United States economy. So that's kind of like market risk. So like whatever market you're invested in, you're taking on that market's risk, that that country's economic risk, basically. And then volatility. So volatility is basically a measure of like how fluctuant stock prices are. So most of the time, stock prices are they usually don't move too much unless there's like a big event that happens that causes a movement in stock prices. But most of the time, you don't see the stock prices moving too much in the short term, other than those big events I'm talking about. But so volatility. So when you're looking at a company at a stock, that stock will be given a what we call a beta. So a beta of one means that that company basically moves with the market. So like whatever the market does, usually that's what that company does that at the same time. Anything below one, you get a little more like it moves with the market, but not as much as what the market does. So think of it as like a percentage. So one is 100%. So it's like 1 to 1, and like 80% of one would be like 80. So like 80 cents. So if the market moved up $1, then that's stock with a beta of 80. Well, zero point 0.8 would be 80 cents, technically. So way to think of it. And then like anything over one, it's like 1.1, multiply it by 1.1. Market goes up one, your stock goes up 1.1. Like it's like the easiest way I can explain like beta. So beta plays a role in volatility because the higher the beta, the more volatile that stock will be during more volatile times. So there's this measurement that SIBO uses, well, calculates. It's called uh, VIX, the VIX, the volatility index, SIBO's volatility index. I don't know if this is it's gonna load a little bit maybe. So this is kind of like a measurement that you can use for volatility. So like the higher that VIX is, the more volatile the market is at that time. So like on December 19th, VIX was at 28, which that's a high number. Usually you want like usually a good number for VIX is like anything below, I would say 15. That means it's like pretty steady. Like 16, it's a little volatile, like it's moving a little. But like anything above 20, that's when you're getting a lot of volatility, and that's when you should be cautious of buying because one day the stock could be up like 7%, the next day it could be down 8%. So this is just something you can keep in mind. Right now, VIX is at 14, so the market sentiment is kind of steady right now. Nothing's really moving the market too much. Nothing's creating too much volatility. So if you're going to enter the market, I would say like I wouldn't say like this is a huge factor of it, but you can use this as an indicator of when you would like to enter the market. So like a 14 on the VIX is pretty steady. So like that, I would say that's a pretty good number. Um, but yeah, so like there's volatility in the market, so you just have to be aware that some stocks are more volatile than others. And then also like economic cycles also play a factor in volatility. So like if you're towards like the end of an economic cycle and there's a downturn ahead, it's probably gonna be more volatile. So, but like if you're in the midst of an economic cycle and everything's just, steady, then, stocks are just gonna maybe steadily increase over time, but not like dramatically. But then there could be events that could affect the stock prices short term volatility. But so then permanent loss versus temporary decline. So a permanent loss is if you bought a stock for let's say $10 and it goes down to $8. It's not a permanent loss until you sell that stock completely. So like it going from 10 to $8 is a temporary decline, but it's not a permanent loss until I sell my stock for that $8 when I bought it at 10. So like there will be market declines and drawdown risk and things of that nature. So you have temporary decline. You could either decide to sell that stock for that, a little bit of a loss, or you could decide to buy more of that stock and do what we call DCA, which is dollar cost averaging. So if I bought it at 10 and it goes down to 8, I can buy more at 8 and it would dollar cost average to $9 a share. So then if it does go back to that 10, then I'd be in profit at that point compared to if I were just had bought it at 10 and held it at 8. And if it went back to 10, then I'd be at break even. So dollar cost averaging is a very nice tool when it comes to investing. I do it quite frequently. So definitely recommend dollar cost averaging, especially if you're pretty confident in a company that you're invested in. Dollar cost averaging is a great tool. Um, but so concentration and liquidity risk is going to like so concentration risk is if you're relying too heavily on like one company or one asset or maybe like one source of funding or maybe one market. So like if your portfolio consists of 10 companies and one of the companies is 20% of your portfolio's value, then maybe you have too much concentration risk because whatever that stock does is going to affect 20% of the value of what your portfolio does that day. So if that stock's down 5% and it's 20% weighted in your portfolio, your portfolio is more than likely going to be down that day. Um, but if you were to spread out your allocation and you took that stock from 20% down to like 10% and you use that other 10% that you took out of that stock and put it somewhere else, you're diversifying and then you're allocating and you're taking on you're basically um not like you're not exposed to that company's risk entirely anymore. Like 20% of your portfolio is a lot for one company. And then like when we get into like the once we get into the procedure manual, um, we'll kind of like see more of like asset allocation and things of that nature. Um, and then you'll decide like how much of one company you can hold at one time. So that's where like we'll get into the nitty gritty of that. But understanding the concept of having too much allocation in one company or maybe not enough in one company is a good like foundation to have before going into all that. Um, but so um, and then liquidity risk is like the inability to meet short term cash needs. So like being able to pay bills and stuff. So just be cautious of like what you're able to invest and what maybe you can't invest. You don't want to like overinvest and then have to take money out of your investments to pay off bills and things of that nature. So just be cautious of like how much extra liquidity you can you can bear basically. Um, but yeah, I would say concentration risk is definitely a big thing. A- And it depends. So like if you know what you're doing and you don't care about concentration risks entirely, I would say that you could take advantage of concentration risk. Like if you've done your research and you know you really you really think that a company can succeed, maybe you want to overweight that company in your portfolio to try to reap more benefit from it appreciating if you believe that's what's going to happen. And like if you believe that maybe a company is going to underperform, you may cut back on your allocation on that company. So like say it's 6% of your portfolio, maybe you want to cut it down to like 4% or maybe 3% before you believe it takes that dip. You can't time the market, but you can you can use your foundation to adjust your investment style. So it's just it's all dependent. It's all situation dependent. Um, the things I'm talking about. So just all depends on your situation and the current situation of like the market and everything. But um, yeah, and then setting expectations for uncertainty. So you can't predict what the market's gonna do. You can't predict what's gonna happen tomorrow. You can't predict what's gonna happen in the future. Can't predict the cycle of the market either. Like there's no predicting the market. You can use information that you get from like reports to build your own thesis, basically your own paths of where it might go. But you could be wrong. I mean, it could be good one day and then the next day everything's just terrible. Like so you just have to set those expectations that there's going to be a lot of uncertainty. Um, and there's no predicting the market. Um, so and then going into like risk management controls. So defining position size limits. So this kind of goes into what I was talking about back here. So defining position size limits. So in your portfolio, you have a portfolio balance. So we'll say it's like $10,000. Here, I might actually just pull up an Excel because it might be easier with a visual. So we'll say $10,000 is your portfolio balance. And then we'll say that we have Apple, Microsoft, NVIDIA, Oracle, Salesforce, I don't know, Lululemon, and I don't know, Amazon. Okay. So our portfolio balance is $10,000, and these are the stocks that we own. So we'll say that we have like, I don't know, 5 shares of Apple, 10 shares of Microsoft, 20 shares of NVIDIA, 6 shares of Oracle, 7 shares of Salesforce, 10 shares of Lulu, and 8 shares of Amazon. Okay, and then I don't entirely know what the prices are of these stocks right now, but I'm just gonna take a guess. So we'll say that Apple's at 191, Microsoft's at 483, Nvidia's at 185, Oracle's at 195, Salesforce is at, I think that's I don't even remember. Lulu, I think it was at like 210. Amazon's at like 230. Okay. So then you don't have to, like, I'm just getting it set up here. So equals this times this. Okay. So this is the amount of shares. This is the price of the stock. So then this would be the total amount that you have in the company. And for weight. So then here, it's how you would calculate the portfolio weight. So you would take your total amount of that stock and divide it by your portfolio balance. And then if it's easier for you, put it in a percentage, like so. So, okay, well, that didn't do what I wanted it to do. So then equals this divided by that. All right, and then should out to 100%. Okay, I don't know how I messed that up. Well, I guess because this probably doesn't equal 10,000. Okay, so 15. Okay, there we go. So this is just like a make-believe portfolio I just made. So as you can see here, Apple is 6% of my portfolio, 30% is Microsoft, 23% is Nvidia, 7.3 is Oracle, 8.5. So based off of this, I am overweighted in Microsoft, Nvidia, Lulu, and Amazon. I'm actually probably overweight in all of these compared to the market. But so like in this situation, I probably want to cut my exposure in Microsoft and Nvidia, and probably a little bit in Lulu and Amazon, and move those funds to different stocks of my choosing. Or if I really do believe that these companies are going to outperform the market, then I would probably just leave it where it is. And hopefully these stocks do outperform the market. Then I would reap even more benefits. So like Microsoft was up 2% one day, then that 2% is going to affect 30% of my portfolio. And then we'll say that this was up 1% and this was down, that was down. My portfolio would more than likely be green because these stock, even if these stocks were red, they only make up 40% of my portfolio, where these two make up 53%, and they're both green. So even if these were red, my portfolio would still be green because these two outweigh what these do to my portfolio. So that's kind of like where allocation comes into play. So like if you think that a stock's going to outperform what the market does, maybe you want to overweight it. And then if it does outperform, then you're going to reap even more than what the market does. Um, and then like if you think that a stock's going to maybe be on par with the market or maybe underperform a little bit, it'd be less of your portfolio's weight because you're not as confident in that company as you would be in another company. And like you decide these things based off like analyzing the company. So like kind of going back to my first video in the Microsoft in the Morningstar Investing Center, you kind of use those as like a gauge of like how to allocate in your portfolio. So like it all ties in to one another, all plays a role into one another. So um, yeah, but so that's kind of like defining the position size limits. So like maybe you constrain yourself to where a company can't be more than like 8% of your portfolio. Then that means that you're gonna have to diversify a lot more. So like it would be a less risky portfolio, but depending on like what kind of companies you're invested in, it'd be less risky because there's more stocks and less overweighting in stocks. So one company isn't going to affect your portfolio more than another one. So it's just less risk that you're taking on. So you're not gonna get crazy gains from it, but there you still have the potential to make good gains with that as well. So um, and then that kind of plays like diversification kind of ties into that as well. So like if you want to diversify a lot, maybe you're a little more risk off than you are risk on. Um, so you may limit yourself or constrain yourself to that 8% allocation, no more than 8% allocation in a stock. So you'll be a lot more diversified. So you may have like 20 stocks in your portfolio or whatever. Um, But on the flip side, you could have that same scenario where Microsoft was 30%. If that's what you want, it's your money, you do whatever you want. But you could have that your portfolio be 30% of Microsoft, and you know, um, that's just the risk that you're willing to take. But yeah, and then leverage and liquidity constraints. So I would never touch leverage. Just don't ever do it, is the best way I could just say it. Because for every, so like when you're on leverage, depending on how much leverage you're on, if you're on like a three leverage, for every dollar you make $3 basically. But for every dollar you lose $3. And then you could get um, whatever, you can get called, you can get margin called, and then you have to pay back what you lost plus whatever your initial thing was, or you'd have to add more money to your account. Just don't do it. You're just digging a grave for yourself. Um, and then liquidity constraints. So like when you deposit money into your account, most brokerages allow you to trade it basically on margin. So it's like a credit basically. So like they'll credit your account, and then once the money transfers complete into your account, then it breaks out, like it ties back to even. So like, but when you make trades like that, you have to hold that stock for at least 7 days. If you sell before that, you can get charged a fee. So just like keep those things in mind. Only trade what you can is my best advice. Don't put more money into it than what you can afford, and you'll be fine. You won't have to really worry about anything there, at least. So proactive versus reactive risk management. So this is kind of this is kind of going into like first level thinking and second level thinking is what I would say. So proactive risk management would be second level thinking. You're thinking harder than just like thinking simply like a reactive risk management or a first level thinking way way of thinking. So when you react to things, you're reacting. Like something bad could happen, and instead of being proactive and having that already in mind and positioning yourself for that to happen, instead you're reacting to the news. And so you're going to take a bigger hit. When you're proactive and you're second level thinking, you're already like you're already taking these things and you're considering these things beforehand. So just being able to apply the the Bloomberg economic calendar, applying those events into your thought process and understanding those things and doing research on those types of things and doing research on economics in general will help you be more of a proactive investor than a reactive investor. And actually, there's a book called The Most Important Thing by Howard Marks that I enjoy. And there's a section in this book that actually talks about this first level and second level thinking. Um, but anyway, so he basically talks about like if you want to be a great investor or be better than average, you have to be a second level thinker instead of a first level thinker. So if you want to outperform the market, make decisions. You can't make the same decisions as the market does. You have to be on the other. You have to be on the other side of the consensus, basically. So, um, if I thought that the Federal Reserve was not going to cut interest rates, but everybody else believes that they are going to cut interest rates, then am I the one that's around the situation, or are they the one that's around the situation? If more people believe that one thing is going to happen, then another thing is going to happen, but the other thing does end up happening, then the people that were on that side of things are going to reap more benefits, and the people that thought were on the heavy side are going to lose more because the consensus was on their side. So um, just do your research and try to become a second level thinker when it comes to these things. Being able to be proactive instead of reactive in this environment is, I would say, probably one of the key things if you want to try to become more than average, I would say. So just keep doing your research, keep doing your deep dives on things, um, understand market risk, understand these things. These things are very important. Um, and take all these things into consideration when it comes to your investments. But hopefully, this was informational for you. I think I covered most of what I want to cover in this for now. And yeah, so I hope you enjoyed, and hopefully, you join us in the next one. Thank you very much. Bye bye.